Most retirees lose thousands of dollars to the IRS, not because they did anything wrong, not because they were careless, and not because they broke any laws. They lose it simply because nobody ever sat them down and explained this one home tax rule in plain, honest language. They sell the house they spent 30 years of their life in, the house where they raised their kids, hosted holidays, paid down slowly month by month until the mortgage was finally completely gone. And then sometimes weeks later, sometimes months later, a tax bill shows up in the mailbox that stops them cold, a number they never saw coming, a number that in many cases wipes out a chunk of the retirement money they were counting on. And the part that really stings, the part I want you to hold on to right from the start of this video, is that this tax bill was completely 100% avoidable. Not partially avoidable, not avoidable if you had hired some expensive accountant years in advance, avoidable if someone had just taken the time to explain the rule clearly, which is exactly what I am going to do for you today. If you are retired right now, if retirement is somewhere on your near horizon, or if you own a home and you know you are going to sell it at some point in your life, what I am about to walk you through could genuinely save you more money than almost any investment advice you have ever received. I am not saying that for drama. I mean it, because for most retirees, the home is the single largest asset they own. And how you handle the sale of that asset from a tax standpoint can mean the difference between keeping a life-changing amount of money and watching a painful portion of it disappear into a tax bill you never prepared for. So please stay with me through this entire video, missing even one small detail here, just one piece of this rule that you overlook or misunderstand could cost you tens of thousands of dollars. That is not an exaggeration. Before we get into it, I want to take a moment to speak directly to you about what this channel is and who it is built for. I make these videos for people who worked hard their entire lives, who want straight answers without the financial jargon, and who are tired of feeling like the tax system is speaking a language designed to confuse them on purpose. I am not here to sell you anything. I am not here to hype up products or make things sound more complicated than they are, so you feel like you need to hire someone. I am here to protect your money, your retirement, and honestly, your peace of mind. If that is what you are looking for, then you are in the right place. I upload regularly on retirement taxes, Social Security rules, IRS guidelines, and the kind of money topics that most people in the financial world explain poorly or not at all. If you do not want to miss videos like this one going forward, hit that subscribe button right now. It is completely free. It takes 1 second, and it makes sure these videos find their way to you when you need them most. All right, let us get into it. Here is something I hear from retirees constantly, and it is completely understandable why they believe it. Once you stop working, taxes get simpler. The house you lived in for decades is basically tax-free when you sell it. You paid it off. You raised your family there, it is yours, and the government is not going to take a cut of that. That belief feels so logical, so intuitively fair, that millions of people never think to question it. And honestly, for a long time, people passed it around as accepted wisdom without anyone stopping to check whether the fine print actually supported it. The truth is, the IRS has very specific rules about what happens when you sell your home, and those rules come with conditions, exceptions, and limits that most retirees do not fully understand until they are sitting across from a tax preparer with a very uncomfortable number on the screen in front of them. This lack of understanding, this gap between what people assume and what the IRS actually requires, costs American retirees enormous amounts of money every single year. The rule at the center of all this confusion is called the capital gains exclusion on a primary home sale, and understanding it properly starts with understanding what capital gains actually means. Capital gains is just a term for the profit you make when you sell something for more than you originally paid for it. If you bought your home 30 years ago for $120,000 and you are selling it today for $520,000, you have a gain of $400,000 on paper. The IRS normally taxes gains like this, but there is a special rule specifically for primary residences that gives homeowners the ability to exclude meaning completely shield from taxes a significant portion of that profit. This is where most retirees hear part of the story, nod their heads, and walk away thinking they have the full picture. They do not, and that partial understanding is where the trouble starts. Here is the rule as it currently stands. If you are single and you sell your primary home, the IRS allows you to exclude up to $250,000 of profit from federal income tax entirely. If you are married and filing jointly, that exclusion doubles to $500,000. For a lot of retirees, particularly those who bought modest homes and have not seen astronomical appreciation, this exclusion is genuinely enough to cover the entire taxable gain. It means paying nothing to the IRS on the sale. Zero. And that is a wonderful outcome when it applies correctly. But here is what the fine print says, and this is the part people miss. This exclusion is not automatic. It does not apply just because you owned the home for a long time or because you have a sentimental connection to it. The IRS requires you to meet specific conditions before you can claim it, and if those conditions are not met, the entire gain can become taxable. The first major condition is that the home must have been your primary residence. This sounds obvious until you realize how seriously the IRS takes it. Primary residence means the place where you actually lived most of the time, not a property you owned, not a house you used occasionally. The IRS looks at tangible evidence, where your mail was delivered, where you were registered to vote, what address appears on your driver's license, and where you actually spent the majority of your days. If the home does not clearly qualify as your main living place, the exclusion is off the table. The second condition is what trips up more retirees than almost anything else, and it is called the 2 out of 5 year rule. In order to qualify for the exclusion, you must have owned the home and actually lived in it as your primary residence for at least 2 years out of the 5 years immediately before the date you sell it. Those 2 years do not have to be consecutive. They do not have to be the most recent 2 years. They just have to add up to at least 24 months within that 5-year window. Now think about how many retirees inadvertently walk into a situation where this rule becomes a problem. Someone retires, decides to downsize or move closer to family, and they move out of their longtime home. They are not in a rush to sell, so they hold on to it for a few years, planning to deal with it eventually. By the time they actually put it on the market and close the sale, 3 or 4 years have passed since they last lived there. Even if they owned that house for 30 years, even if it is the only home they ever truly called their own, the 2 out of 5 year clock has run out. The exclusion no longer applies, and the IRS may treat the full gain as taxable income. Another situation that catches retirees completely off guard is just how much their home has appreciated over the decades. People who bought homes in the 1980s and 1990s in what seemed like perfectly ordinary neighborhoods sometimes find themselves sitting on gains that would have seemed unimaginable when they first signed the closing papers. A house purchased for $100,000 in 1988 might sell today for $650,000 or $700,000, depending on the market. That is a gain of $550,000 or more. The exclusion is generous, but it has a ceiling. For a married couple, that ceiling is $500,000. Anything above that amount is potentially subject to capital gains tax. So in that example, $50,000 or more could still land on a tax return as taxable income. A lot of retirees assume the sale is entirely tax-free, never do the math ahead of time, and then find out at tax filing time that there is a bill waiting for them on profit they never expected to owe anything on. This is also a good time to talk about something called cost basis, because it is one of the most underappreciated tools retirees have when it comes to reducing the taxable gain on a home sale, and most people have never even heard the term. Your cost basis is the starting value the IRS uses to calculate your profit. It begins with what you paid for the home, but it does not stay there forever. If you made major improvements to the property over the years, those costs can be added to your basis, which effectively increases your investment in the home and reduces the taxable gain. We are talking about things like adding a bedroom, fully remodeling a kitchen or bathroom, replacing the entire roof, upgrading the electrical system, or finishing a basement. Each of those projects, if properly documented, can raise your cost basis and lower the number the IRS considers your profit. Here is the painful reality, though. Most retirees never kept those records. A kitchen remodel from 1997, a roof replacement in 2004, a bathroom upgrade in 2011. These were real investments in the home, but if there are no receipts, no contractor invoices, no permits on file, those costs cannot be added to the basis. The taxable gain looks bigger than it actually should be, and the tax bill reflects that. This is one of the most common and most frustrating ways retirees lose money they did not have to lose. Going forward, if you are still in your home and you are planning any kind of improvement project, keep every receipt, every invoice, every permit. Create a folder, physical or digital, and treat that paperwork like it is worth money, because one day it will be. It is also important to understand the difference between an improvement and a repair, because only one of them helps your cost basis. Routine maintenance, fixing a leaky faucet, repainting the interior, replacing a broken appliance does not count. These things keep the home in its current condition, but do not add to its value in the IRS's eyes. Improvements, meaning projects that add meaningful value to the home, extend its useful life, or adapt it to a new use, those are what count. Understanding that distinction before you sell can make a real difference in your final tax picture. There is also an important situation involving second homes and vacation properties that I want to address directly because it surprises a lot of people. The capital gains exclusion only applies to your primary residence. If you own a vacation home, a rental property, or a piece of investment real estate, that exclusion does not automatically extend to those properties. Some retirees assume it does and are blindsided when they sell. However, there is a planning strategy worth knowing about. If you own a vacation home and you make it your primary residence, move in, live there, and meet the 2 out of 5 year rule before you sell, you may qualify for a partial exclusion. It is not as simple as flipping a switch, and it does involve some complexity because the IRS will look at how long the home was used as a rental or vacation property versus a primary residence and may limit the exclusion accordingly. But when done correctly and planned carefully, this approach can still meaningfully reduce what you owe. One thing retirees often overlook entirely is how a home sale interacts with the rest of their financial life for that tax year. Even when the exclusion covers most of the gain, any taxable portion that remains gets added to your total income for the year. That increased income can push you into a higher tax bracket. It can trigger higher taxes on your Social Security benefits. It can raise your Medicare premiums through what is called IRMA, the income-related monthly adjustment amount. Retirees sometimes focus exclusively on the home sale tax itself without realizing that a large sale can ripple through their entire financial picture in ways that cost them in other places. Timing matters more than most people realize when it comes to this decision. Selling in a year when your overall income is lower, perhaps early in retirement before required minimum distributions from retirement accounts kick in, can mean a lower capital gains rate on any taxable portion of your home sale profit. On the other hand, selling during a year when you have heavy income from pensions, RMDs, or other sources can push more of that gain into a higher tax bracket. This is exactly the kind of planning that a tax professional or financial advisor can help you think through well in advance. It is also worth knowing that this exclusion cannot be used unlimited times back to back. Generally speaking, you cannot claim it more than once every 2 years. For retirees who are downsizing, moving into a retirement community, or shifting residences more frequently, this matters. Using the exclusion on one sale too soon can disqualify you from using it on a subsequent sale that might have involved an even larger gain. Life events like the death of a spouse also affect how these rules apply. A surviving spouse may still qualify for the full $500,000 married exclusion if the home is sold within 2 years of the spouse's death and other conditions are satisfied. These are rules that people rarely think about during an emotionally overwhelming time, which is exactly why knowing them in advance is so valuable. The single most important thing I want you to take away from this video is this. Selling your home is not just a real estate decision. It is one of the most significant tax events of your entire retirement. Treating it casually or assuming that because you lived there for 30 years, everything will be handled automatically and tax-free is a mistake that has cost countless retirees real money. The IRS rules are specific, the conditions are real, and the details genuinely matter. With the right knowledge, with a little planning done years before you ever put a for sale sign in the yard, you can protect yourself completely. You can keep the money you earned. You can walk away from that sale with your full financial picture intact and your retirement comfortable. That is what this channel is here to help you do. If you found value in this video, please subscribe right now. It is free. It takes 1 second, and it means you will not miss the follow-up videos I am going to be making on this exact topic, breaking down each piece step by step with even more detail. This community is built for people who worked hard and deserve straight answers. I will keep showing up for you. Until next time, take care of yourself and protect what you have earned.